Whether value investing is dead or not is another question. And the answer that you expect me to say is no, and I'm going to say that. I'm also going to say it might be. I'm also going to say I don't know. And I'm finally going to say I don't care. So I think I cover everything. As far as value is concerned, according to Russell data, value investing did quite well for a long period of time. 1980 to 2006, it outperformed the market by about 2% a year. Since then, last 12 years, growth has outperformed the market by about 5% a year. Hence the question, sort of, or at least the worry that value investing is dead. And if you looked at the first 9 months of this year, Russell has an index called Pure Value, which really takes the 400 stocks in the Russell 1000 that are closest to value. That was up 1.7% for the first 9 months. The Russell Pure Growth, that was up 28.6%. So underperforming once again, continuing. And why some value investors, at least it's corrected a little bit since then, but still that dichotomy has been going a long time, and they just put another nudge into the value investing world during the first 9 months. Why? So it looks like value investing might be dead. On the other hand, what is value investing? Russell defines it, amongst other things, and Morningstar would define it as low price book, low price sales investing. To us, and the answer is, if you're talking about will low price book, low price sales investing come back, the answer is I don't know. Okay? I usually use the concept of momentum. These are things that have worked in the past. Another thing that's worked well in the past is something like momentum. And it's very clear, a lot of research studies, that momentum's worked very well for the last 30, 40 years, and not just in this country, but across the globe. With one or two exceptions, momentum's worked really well. My problem with it is that if it did not work for the next 2 years, it could be that momentum is just cyclically out of favor, and all we have to do is be patient. And it works over the long term. It's cyclical, and it didn't work for the next 2 years, but that's fine. Stick to it. It works over the long term. Plenty of evidence that has been so. But the other choice, if it doesn't work for the next 2 years, is that there is more data, ability to crunch numbers, computers, smart people, not so hard to figure out a stock used to be down here and now it's up here. It's got good momentum. And the trade over the next 2 years has become crowded, and the returns have been degraded, and that's why it didn't work over the next 2 years. And 2 years from now, I won't know the answer to that question. Whether it's just cyclical momentum works over the long term, it's cyclically out of favor, or the trade is crowded and degraded. I feel the same way about low price book, low price sales investing. Why does a company trade close to the historic cost of its assets? Well, people aren't giving much of a premium for the actual underlying business, that's clear. It's likely if you bought a bucket of companies selling closer to their book value, you will get more than your fair share of companies that are out of favor. People don't like or aren't valuing the business very highly. And I believe that's why it's tended to work over long periods of time before the most recent past. But once again, like momentum, it is a correlation with something that's worked well in the past. I think it worked well because low price book, low price sales investing has correlated with getting more than your fair share of out of favored companies. And if you ask me whether it's going to continue to work, I say maybe. I'd say possibly likely, but I'd mostly say I don't care. Once again, momentum, low price book, low price sales, all these kind of factors that have become popular with people in different investment styles are correlations with what's worked well in the past and might indicate that you're getting more than your fair share of a type of company. My first day of class, I've taught at Columbia for the last 23 years, and my first day of class, I promised to my students that if they do good valuation work, the market will agree with them. I just never tell them when. Could be a couple weeks, could be 2 or 3 years, but if they do good valuation work, the market will agree. The market will agree with them. Stocks are ownership shares of businesses that we value and try to buy at a discount. They are not pieces of paper that bounce around that we put Sharpe ratios and Sortinos on. Big difference. So it is possible that if we're good at doing valuations on businesses, the market will not reward us over the next couple of years, but that doesn't mean we're going to stop doing what we're doing. That's what stocks are, ownership shares of businesses. And so that is actually causation. We're like private equity investors when we think about stocks. We're buying the whole business, like most investors would. And so I don't know about value investing as defined by Morningstar or Russell, may go in and out of favor or may stop working, I don't know. But valuation investing, that's what stocks are, ownership shares of businesses. So as Warren Buffett would say, value and growth are tied at the hip. Growth is a portion of how you value something. So I think that whole discussion, as bad as the statistics are, they're not very meaningful to me when I think about being a value